The Watson Weekly Podcast is sponsored by Miracle. You don't need another tool, you need a growth partner. The Miracle platform is powering the next era of retail for brands and retailers who are ready to move. Powered by AI and built for what's next. It's February 16th, 2026, and this is the Watson Weekly, your essential e-commerce digest. Today on our show, Amazon is a vertically integrated utility. Shopify fiscal year 2025 earnings, a pony with one great trick, could it be more? Kroger opens a new marketplace. And on PayPal earnings and David Marcus. And finally, the Investor Minute, which contains 5 items this week from the world of venture capital, acquisitions, and IPOs. But first, in our shopping cart full of news, Amazon is a vertically integrated utility. Retail is just another use case at Amazon now. What blew me away most from the earnings call is not just the $200 billion investment compared to $175 from Google in new AI-powered data centers. It's the growth rate. Combined with its efforts to build chips, Amazon is looking to be the electricity powering the AI revolution. Starting with AWS, or should I mean AIWS? It's significant that Amazon starts its earnings call speaking about its data center business. Here are a few eye-watering stats you just don't see normally. AWS is growing 24% year over year with an annualized run rate of $142 billion. This is the fastest growth in 13 quarters. AWS revenue backlog is now $244 billion, up 40% year over year and 22% quarter over quarter. Jassy says the AI market is in a barbell effect right now, meaning there are a few runaway applications, likely he means things like Claude Code and OpenAI, but not much in traditional enterprise loads yet. And at the other end, enterprises are using AI mostly to eliminate costs, not to run their primary business. And this is from the same company that doubled its logistics network during COVID, built the Kindle and the Alexa, and invented an entirely new data center category, and is also launching low Earth orbit satellites. But what about the chips? Amazon's chips business, or AI-powered chips for its AWS customers, it's also largely discounted by the market. They have multiple billion-dollar businesses already growing fast. The entire chips business is over a $10 billion run rate. Graviton, for instance, is a multi-billion-dollar run rate business growing 50% year over year. Is it any wonder why they are promising these CapEx numbers? And speaking of CapEx, about that $200 billion number, the most controversial thing in the stock market this last week is the investment in data centers from Google and Amazon. Amazon has thrown down a gauntlet. We will not be outspent in AI data centers. Period. End of discussion. Personally, I don't think it's an accident that the company has a $244 billion revenue backlog while it's investing $200 billion in new data centers. 22% quarter-over-quarter growth in revenue backlog is hard to fathom at Amazon's scale. From where I sit, Amazon is making a prudent investment in its future, and I have no doubt that Jeff Bezos would be doing the exact same thing. Yes, that Jeff, the same guy who said that perhaps Amazon is not for you if you expect Amazon to ever make money. Amazon will always invest first and then look for ways to make money later. Always. In my mind, Amazon would be dumb not to invest this much. Amazon is now the power plant of the AI revolution. E-commerce is still largely a supply chain exercise. When will people get it through their freaking heads? Supply chain excellence is the gas which powers Amazon's retail flywheel, and forever shall it be. Here are a few interesting tidbits I took from the Amazon retail side. Amazon delivered 70% more same-day items compared to last year. Amazon launched a new feature, Add to Delivery, which injects a new item into an order already in flight. This is already 10% of Amazon Prime volume each week. Amazon added another 2 delivery zones to its network, totaling 10 regionalized zones in North America. I hadn't heard this anywhere else. Marketplace is still foundational to Amazon retail. Worldwide third-party seller units reached 61% of total paid units in Q4 2025. Seller services revenue rose 11.2% year over year, exceeding analyst expectations. Over 400 new brands were added, including Nike and North Face, and they've deepened their presence on the marketplace in 2025. Amazon's ad business is still growing and, of course, getting short coverage, but there's still a lot to be excited about here. There were $21.3 billion revenue in the quarter, growing 22% year over year. Prime Video's ad-supported audience has expanded significantly to $315 million globally, up from 200 million users in early 2024. The company is continuing to invest in AI tools to allow brands to generate and deploy ads in minutes instead of days. In terms of the stores business, forgive yourself if you forgot Amazon actually sells stuff. The company had 10% growth year over year, up from 8% in prior quarters. And of course, it's Q4. In 2025, Everyday Essentials grew twice as fast as every other category. At this rate, could Amazon be on the path to becoming America's largest grocer? Everyday Essentials are now 1 out of every 3 units. Keep this 33% number in mind in the future. Grocery is almost 60% of Walmart's sales. All told, Amazon is still on a tear, mostly powered by data centers. Our second story. Shopify fiscal year 2025 earnings. It's a pony with one trick, but could it be more? Shopify is on a tear and seems like it will continue to be, fueled by its 36% gross margin payments business. This is Shopify's trick. Its ability to turn good enough, sometimes great features into platforms, into payments gross profits. Combined with its sales and marketing leverage or brand and ability to control its other operating expenses, this is a magic sauce of Shopify. All the other platforms' fumbles and foibles over the last 6 years have been a tailwind, of course. But let's be clear, Shopify has also executed super well. Shopify's ultimate goal must be to be in the hyperscaler category, meaning Google, Amazon, Meta. To do that, it needs a true consumer business, Shopify Prime anyone, an advertising business, or a much faster way to expand its payments gross margins. As far as I can tell, Shopify is giving away 64 cents of every payments dollar to its cost of goods, i.e. Stripe. Could that change? Well, it reminds me of another company out there who was using third-party providers for a big part of its business, Amazon. They said Amazon could never build its own logistics, yet build it, they did. Could Shopify build its own payments business? It has made inroads versus PayPal, but they don't own their own rails, and it's one of the biggest blockers facing the business making a giant leap forward. The other way Shopify could get to be a hyperscaler feel farther afield. In particular, a meaningful ads business. Shopify's true inventory for its ad placement would be limited to its own products and merchants. That's very tiny, relatively speaking. That ads potential is not even in the same galaxy as the other hyperscaler companies out there whose advertising business is only limited by the universe of search terms that billions of people type in daily, or what these same billions write or post videos about on social media. The only other asymmetric bet out there is really Shop App, which could become the Shopify Prime of Shopify in the future if they play their cards right. But still, it needs a reason to exist that isn't a merchant value proposition. The consumer value prop does not approach the best marketplaces on the planet, and will not soon. Another sign that Shopify is not going to soon be a hyperscaler? They announced a $2 billion share buyback, meaning it couldn't find a good use for that $2 billion except to offer it as a sacrifice to the Wall Street gods. When Amazon, at the same time, in the age of AI, freely spending $200 billion in CapEx to get ahead of a $264 billion AWS sales backlog. Just to be clear, this is not throwing shade on Shopify. It is, however, framing the road ahead if it wants to be something greater. Our third story, Kroger's marketplace that's not a marketplace. In the world of commerce, we often see words stretch until they lose their original meaning. Take Kroger Marketplace. If you're a marketplace operator, you hear marketplace and think third-party sellers, distributed inventory, and capital-light scaling. You think Amazon, Miracle, or maybe you're thinking of Kroger's own third-party digital marketplace, which, of course, you can't think that anymore because, according to public reports, they killed it. In March 2025, Kroger quietly sunset its Kroger Ship service and its Miracle-powered third-party marketplace. What do you know? Turns out running a digital endless aisle in grocery is harder than it looks when shoppers want their eggs and milk in 2 hours, not 2 days via UPS. I would tell you that the physical marketplace format that they did announce is very much alive and expanding. It's less about a platform business model and more about assortment expansion and real estate optimization. These are big box supersized stores over 120,000 square feet that blend traditional groceries with general merchandise, apparel, home decor, and even jewelry. The strategy is Kroger's answers to the one-stop shop dominance of Walmart and Target. They aren't aggregating third-party sellers under one roof. These act as a curate and carry retailer, serving as the primary merchant. The distinction, while Kroger tried the digital marketplace to compete with Amazon, they've retreated to what they know. Brick-and-mortar bets on foot traffic and basket size, high capex, high touch, and zero platform fees. And our last story, goodbye PayPal? David Marcus, former CEO of PayPal, once said, "In the end, you should only build what you're willing to bet your career on." Looking at PayPal's latest earnings, I have to wonder if management is prepared to go all in or if they're simply managing a slow-motion car crash. Of course, Mr. Marcus also just came out with a scathing tweet about PayPal's leadership, conveniently, since he left. The earnings numbers tell a story of a giant grappling with its own shadow. Revenue missed expectations at $8.68 billion, and an earnings per share of $1.23 came in light. The stock took a 16% haircut. Investors aren't just disappointed, they're losing patience. While Venmo remains a bright spot with 20% growth, the branded checkout business, the engine that actually built the house, is stalling. And there are 3 things to watch here. First is execution. A CEO transition mid-quarter is rarely a sign of a steady ship. Why not move to the permanent CEO immediately unless this was a rush job? Not a good look. Second is product stickiness. If transactions per active account is dropping, your moat is evaporating. And finally, the competitive landscape. Apple and Shopify aren't just knocking at the door, they have moved in and are rearranging the furniture. But about that David Marcus tweet, and I mentioned it before, but I thought I would say a little bit more about it here. David, of course, talks about PayPal as if the company started on his watch and then the problems started after he left. The truth is, while the company had problems after he left, the rot actually started long before. PayPal and eBay are part of a fossilized breed of Silicon Valley company. Very successful early, built a lot of code that then became a straitjacket for the company, one from which it could not extricate itself. For eBay, the auction was the opportunity and then became the problem. For PayPal, the peer-to-peer auction beginnings caused many of the same issues. Put simply, Venmo could have been to PayPal what Instagram was to Facebook. However, I could just as easily argue it was too late for PayPal by this point, even when David Marcus started. The really, really dumb idea was PayPal being acquired in the freaking first place. PayPal had a much bigger total addressable market than eBay, but didn't realize it at the time. By the way, I don't think Stripe will make the same mistake that PayPal did. It's that time, friends, for our Investor Minute. We have 5 items on the menu today. First, FIA raises $35 million to make shopping fun again. Another Gates is making news. Phoebe Gates and Sophia Kianis' FIA raised $35 million in Series A funding. Second, video to 3D product content platform Voxello secures £346,000 in pre-seed first close. Product content platform Voxello announced it raised $385,000 in pre-seed funding. Does this work in an agentic world? Third, Grub Market raises $50 million Series H. H stands for heavy. Grub Market announced a $50 million Series H funding round to support product development and potential acquisitions. Will Grub Market be an IPO candidate this year? Fourth, private equity firm acquires Buddy's Home Furnishings. Skyline Investors announced its acquisition of Buddy's Home Furnishings, the third largest rent-to-own franchisor, for an undisclosed amount. Is it any coincidence that Bob's Discount Furniture is planning to go public? And finally, AutoUnify announced a strategic investment from Experian. AutoUnify, a toolkit that connects AI agents and applications to automotive retailers and repair shops, announced undisclosed funding from Experian. That's all for this week. Till next time, Watsonians. Hi, I'm Rick Watson, CEO and founder of RMW Commerce Consulting and host of the Watson Weekly Podcast, your essential e-commerce digest. To hear new episodes of the show every Monday morning, subscribe now at rmwcommerce.com/WatsonWeekly and wherever you get your podcasts.